Hey guys and girls, thanks a lot for tuning in for Wednesday webinars. We've had Tuesday night chats, but here we are on Wednesday webinars. So maybe if I can just get everybody, if you can hear us, just make sure if you can just write a little note to say you can hear us. That'd be awesome. Cool. Thanks guys. I can see some new names here, some people that I'm familiar with, so welcome everybody, and thanks a lot for spending your Wednesday evening watching this. And I think hopefully you'll get a lot from this evening. Always talk about how building a property portfolio, it comes down to having the right assets, but ultimately if you can't fund those assets, then you can't build that portfolio out. So yeah, with it, I see I'm looking sharp here. I do have my tie and my shirt on. I was just at the shops, and someone said, "Oh wow, you've got a pair of thongs," and I'm like, "You're lucky to see me with a shirt and tie on." So yeah, with it, I want to introduce Rose Renouf. Rose has been my personal broker for the last sort of 15 years, would you say?
Well, you were only 19 when I met you.
16 years.
16 years, yes.
Yeah, that's great hair. That's great hair. I've got a face full of it, a head full of it. Yeah. So, and I think over the last 16 years, you've probably written about 80% of my loans.
I think even more, because when you first started, I remember you only have one property, which was a two, I think, in Penrith. And then I started a townhouse in Trafalgar. Do you remember that? There were two townhouses.
Yeah. I think.
Yeah, you were then an employee of Cumberland.
Yeah. I was working in a job, so yeah. So I'm seeing someone saying that it sounds a bit off. If there's any issues, just let us know. We're no IT experts. A lot of people saying it's all good, the sound, but yeah, it's been a long time, Rose.
Yeah, and look at you now. I've never thought.
Yeah, it's been an interesting journey, and I appreciate everything that you've helped me with.
Thank you.
And I'm excited. Like a lot of people here that have been a part of the B.Invested community for the last 11 years of the business being in existence may not have had the opportunity to know who you are.
There were some here that I could read names. Deal with them already. So
yeah, there's a lot of people that don't know you. It's good to get everyone to know you.
And hoping to know them as we go.
Cool.
With Zinger will be the best mortgage brokerage.
Cool. And with it, just a bit of a background on Rose. Like apart from the fact that she's been able to help me build out my portfolio, Rose has been running her firm for how long have you been a broker for now?
I have been a broker for 19 years, but I specialize in residential. I do commercial lending as well and private lending, but most of my portfolio are for investors. Yeah. And prior to that, before I became a mortgage broker, I worked for the company called Striker. I was a HR manager, and I also worked for Nortel. Mm-hmm. And being an HR manager, I do understand the composition of your pay, like for example, salary packaging, that sort of thing. So that helps me understand your pay slips. And at the same time, I have a degree in Bachelor in Commerce, major in accounting. So I do know how to read your financial profit and loss and balance sheet and also tax returns. So that helps me understand your situation and be able to structure your loan according to your needs and what you earn. So
cool. And with it, I spoke to you about building Zinger Finance like 10 years ago, 8 years ago, and I've been trying to get Rose to come on board and look after the team here and get it cranking. I want to build a bank. A lot of people may or may not know, one of my goals is to build a bank, and need to have the right people, the right infrastructure in order to be able to do that. And basically Rose has said that she's as of on my birthday, 18th of May was your first day here.
Yeah.
Rose has come on board to head up the Zinger Finance team, and yeah, with it, really excited to see you lead the team and take the business into the next level of where we're heading, and head up Zinger Finance. So yeah,
Thank you.
Excited to have you on. So with it tonight, you know, I encourage everyone to ask questions. You know, pop them in the message box. We'll get to them at the end of the presentation. I might flick through them through the middle to see if there's any you know, breaks where people want to ask some questions. But tonight, you know, obviously we're in a very different sort of finance market than what we were, 15 years ago, 16 years ago. We have different challenges. So would you say it's harder today?
No, currently the bank has a lot of changes in their lending policies, and also the impact of the COVID, and the bank has adjusted their policies as well. So I will be touching base as to give you a guide what the bank's policies are, and basically to make it possible for you to be able to borrow.
Cool. And so the finance market sort of always changes, right?
Always changes. I mean, sometimes the bank policy was only last month, and then next time I know it changed again.
Yeah.
So
yeah, it's constantly. Cool. Well, let's get straight into it. And this is your biggest gripe,
yeah.
I've seen with a lot of people, that's causing a lot of grief. So I'm going to leave it with you to talk to everyone about.
Now, with the superannuation release, as you all know, we can access your super 10,000 for the 2020 tax return, and another 2020 year end, and another 10,000 again in 2021. Now, when that superannuation hits your bank account, the bank will know that, because part of the documents that the bank required is a copy of your bank statement. Once they have realized that you have accessed that super money, they will then think like, okay, you must have a reduced income, your hours has been reduced, and you're no longer receiving bonuses or commission. So that would have a big impact in borrowing. And also the bank view that as, you use the super to meet your commitments. And also it cannot be used as part of the deposits. And we have come across with that recently, and the problem we have is the loan get declined. So think again if you do access your super. I do have encountered some of the clients that I have has like, they have 200,000 in their savings account, and I go, why did you access your super? He said, because I can. But this is the thing that we need to educate, that no matter you have 200,000 in your bank account, you have to wait for another 3 months before we can even restructure your loan or recommend some, or your further borrowings would be impacted. So
something funny that I had sent to me this morning, I'm just going to pop it up on the screen. This here is from 8:36 a.m. this morning. This is the ATO website, and it is closed, right? It says we're currently experiencing high volume of traffic. And basically this morning, so many people tried to jump on as soon as the clock turned over to access their super. All these people that are accessing their super. What are the banks saying about?
I think what the bank was saying, like we would say, like, look, he's got 200,000. No, he only accessed the super because he can. And then the bank said, if you read the brief as to who are entitled to access the super, it doesn't really make sense, isn't it? Then it become a character assessment for that person, because then, like, if you have 200,000, you access your super, I mean, that just doesn't say much about you. Yeah. So that's even worse, because why would you? And then it doesn't really satisfy the ATO's requirement in terms of why you should access your super.
So many people out there, just jumping on it, right? And it sounds good, right? In theory, like you can go get 10 grand out. If you've got a spouse, you can get 10 grand for the husband, 10 grand for the wife. Wait another 2 months, get another 10 grand, another 10 grand. You can get 40 grand together, but you're going to be waiting a whole year.
Probably you have to wait. Say for example, if you're going to access for 2020, this financial, this this year end, start today, you have to wait for 3 months before we can even lodge an application. 3 months being the bank would require your bank statements, 3 months of your 3 months history of your transaction account or your savings account. Now, if it shows there that you have access to your super, it just doesn't, it will not stack up.
Yeah, and just as a bit of a disclaimer as well, like none of the stuff obviously we say is financial advice. I've got a question here from Chris that says not many people have 200 grand in the bank. What about those that have got it for a leg in housing? Everybody's position is different. Do as you please, but just everybody's position. If you can't buy a property, then you may not be buying a property for 3 months or 6 months. So that may be an option for you if you are doing so. But no advice to go do that. But if you are thinking of buying a property anytime in the next sort of, let's say, 6 months, there is ramifications. It's going to affect your servicing. So I think what Rose is saying is you need to make a call whether you're going to be buying for the rest of 2020, or if you're going to be sitting on the sideline and coming back next year just because you've felt like the need to go and get your super if you may not need it. So yeah, I noticed that you had some little notes here as well, some lender considerations as well.
These are the questions. These are the COVID questions, right? Nowadays, the bank would ask like, has your hours has been reduced? And are you receiving the same base income pre-COVID, or have you elected to take leave without pay or reduce pay? And also, are you a recipient of the job keeper payments? Please note that the job keeper's payment can also be considered as an income. And when we use that for servicing, they will ask like a question, a letter from your employer as to what was your income pre-COVID and what would be your income post-COVID, which is hard to satisfy, I think, sometimes post-COVID, because some of the employers would not even know how to certify that in terms of how do we know if the business will go on, like, Yeah. So yeah, so those are the COVID questions. And some of the lenders, they need to have it in writing, all the questions. So before we submit an application, we would be asking you all these COVID questions that the bank required, and I do require it to be in writing. When I send you an email with regard to this question, you have to send it to me back in writing, and that will be one of our supporting documents.
Cool. Anything else on the topic, Rose? Or
no.
Move on for the next page? Yeah, cool.
Oh, this one is my favorite. Loan repayment post. So this sometimes people refer this as repayment holiday. So what it is now, because the bank, you can't freeze your loan repayments, right? If you obviously experience some meeting your commitment, but unfortunately, if you have to refinance that loan, that particular loan has to have, we have to provide 6 months loan statements. Say, for example, if you apply for a loan in August, that means 6 months back would be February, March, April, May, June, July. So maybe from March. Now, if COVID, I think it started in March anyway, posting your loan repayments. End of March.
April, yeah.
So basically, we cannot present it to the bank. I mean, you look at some lenders would even put hardship, which is not fair, because I think that was debatable. I think one of the lenders, from memory, it was ING, they put like hardship. So that is so basically, if you want to refinance that loan and it says you freeze your loan, so that means we can never refinance it. At the same token, if you want to, for example, you want to top up your loan to use the equity, and the bank knows you free, obviously they will know that you post your repayments, that is also not possible. So it will really hinder your future borrowings. Now, there are also things there that you freeze your loan repayment, and even if you did, you still keep paying. So that's not bad at all. But I haven't met. There were instances that if your payments is principal and interest repayments, and the bank has reduced it to just you negotiate will be only interest only repayments, we may be able to do it, refinance that loan provided that you've been paying regularly, albeit it was a reduced amount.
Cool. And any other notes on freezing or?
No, I think freezing for the purpose of freezing is not really favorable to you.
Cool. Well, I think maybe we'll just go to a few questions as well before they all add up, because there's a lot of questions here as well. So I'll just read them out. So Chris just wrote Ridwan, when we had Ridwan on, he also explained the tax implications of accessing super as well. So if you are sort of taking that super out, there is implications upon that as well. Matt, he wrote, what is the percentage of rental income that the banks are currently considering? Example, if you earn 100 grand rental income annually, how much would they consider when working out serviceability?
Okay, the rental income, the assessment for servicing, say for example, different lenders say, okay, 70%, they will take 70% of the rental income provided we don't provide the investment cost. Let's take, for example, two big lenders. We don't, you know how there's a question, how much is to keep that investment, how much it will cost you a year. So two lenders would not ask for what's the investment cost, then they will assess the rental at 70%. Whereas there are also other lenders that they will ask, oh, how much it will cost you to maintain the investment. And if we provide it, they will assess the rental income at 80%, so between 70 and 80%.
And if it's owned outright, you know, we've got the caps as well, like say if you buy the rental cap, like the rental yield cap.
So what happens if, for example, if it is a purchase, let's take like a purchase, and then if it's worth 200,000 and the rental is 10% yield, the bank would cap that to 7% or 6%. Now, if we get away with it sometimes, if, for example, your yield is 10% and, you know, sometimes the valuation of the property is lower, but if we use the market value for the property instead of 200,000 where the bank valued at 200,000, but for us, it's the market value is 250, so we can use the basis of the market value for the yield.
Cool. And I think I've made some videos recently as well, which maybe we'll touch on a little bit later on this evening, about having a debt sort of strategy, like the accumulation phase and the consolidation phase of the debt. And it made me just think about a question here from Steve. Steve asked, some people can afford the rent and also the mortgage. However, people cannot get a 10 or a 20% deposit. The bank won't give out the loan. Why? So,
no, it's not correct that we always have 20% deposit for investments. I've done a lot of 10% deposit as long as you're willing to pay the LMI. So sometimes the bank would probably refuse if the total exposure that they have from you, obviously, it is an LMI deal, but definitely we don't need to have 20% deposit. But the 90% that is an LMI deal, so that has to be approved by the LMI insurer, which sometimes they use Genworth or Allianz or QBE. Yeah.
And basically, when you add mortgage insurance, like I think our books, like they're predominantly like 98% of the books are sort of 80% loans, but everybody's position is different though too. So like some people can get in for like a 5% deposit.
Well, there's no longer 5% deposit. That's only for the owner op. For investment, you can do 90% inclusive of LMI. So that is inclusive. But for owner ops, you can do 95% inclusive of LMI. And there is also another lender that can do 98%, which is capped LMI for owner op. However, the interest rate is really higher.
Yeah, it's crazy.
Yeah, so there is a trade-in. Yeah.
And how many lenders do you reckon out there? If someone says no, like someone thinks they can't get a loan, how many lenders would there be roughly in the moment? Like hundreds? Just any property.
For 98%.
People think, no, like just in general, like say for instance, people think you've got the big four banks, you've got some smaller banks, you've got some second-tier lenders, like it's dozens, hundreds of lenders in the country. Like
there are, predominantly I have brokers. We don't really, for me, I don't really use a lot of lenders. I have enough lenders to cater everyone's, situations. For example, the 4 main lenders as well. I have the second tier.
Yep.
And also we have non-traditional one, and we also have private lender for commercial, but the non-traditional one, they're not bad actually. I mean, it could be just only 0.6 or 1% higher than what the banks offers. But then again, you cannot borrow through the prime lenders. Second tiers are not bad.
Yeah. Cool. And there's a question here from David. If you are able to borrow $1 million, can you buy 3 properties with that, or restricted to only 1 property per loan?
If you have what is $1 million?
I'm trying to reread it. So if you can borrow $1 million, I'd assume that means that you could borrow $1 million and spend it on, one $1 million property, 5 200 grand properties, 10 100 grand properties is what they've questioned. Yeah.
Well, 1 million. How much is per property?
Exactly, like if the servicing is $1 million.
Yeah, 1 million. Obviously, if Nighton can provide you a 300,000 property, that brings you to 3 properties.
Yeah. Cool. And I'll just read 2 more questions, and we'll get back on the slides. Murali asked, I had freeze my mortgage payments. Can I still borrow? I'm not looking at refinancing on the existing loan.
Okay, that's a good question. Okay, there are okay. I have to be careful what I say here, right? Because this is if you're gonna do purchase, not refinance, some lenders would not require current statements of your existing loans. Yeah, so they will not see that you frozen the loan. However, there are also a question there that some lenders would cover themselves that says, have you, leading to that question, like, have you experienced financial difficulties during this COVID? So we have to disclose it.
Yeah. And then Chris just asked a question. Hey Rose, Birchy, I'm currently closing on a property with B.Invested over the next couple of months. I'm considering a job offer and move back to Sydney. Would this be a problem for me? For the loan, it would be the same job, and I should still make 150.
Okay, I would like to answer that, right? That's a very good question, because often people don't know. Say, for example, okay, you change job, the same industry, even if it's not the same industry, as long as it's no more than 28 days. So you can, there is no problem doing that. There is a lender that would cater for that, as long as the gap between the last employer and the new employer is no more than 28 days.
Okay, cool.
So it's still considered as continuous employment.
And if someone so basically someone's just changed jobs, or they've just got a job, like someone hadn't been working for 6 months or something, been traveling or something, and they get a job, how long did they have to wait? It's a common asked question.
Okay. If you haven't been, general rule, 3 months.
3 months, okay.
Yeah, 3 months.
Cool. And just one last little comment here. I see Luke asked, Nathan, did you just come from a job interview? No. Occasionally, everyone's freaking out and I'm wearing a suit and tie just for the fun of it. I've got about a half dozen staff in here that are new in the office. We've got sort of over 40 staff here in the headquarters, and I just wanted to set a bit of a different standard by occasionally wearing a corporate sort of get up. So then, I'm setting the precedence. If I'm going to be wearing that, then everyone else needs to be professional, not so chill. So with it, cool. Let's get back to the slides. Next slide. Interest in advance and the financial year.
Interest in advance. This is probably the less being talked about. Interest in advance. To give you a background, interest in advance is basically for investors, right? This is for fixed rate, interest only investment. So what it is, from the beginning, say for example, I settled a loan today. So that will be my anniversary date, 1st of July. At the onset, say for example, your property, your loan is 4%. Say for the purpose of this exercise, your loan is 200,000 at 3%. So the interest rate for that is 6,000 a year. So from the commencement of that loan, when it's settled, you have to pay 6,000 a month. or 6,000. That will be for the duration of the whole year. And on the second year, if your fix is for 3 years, and on the second year you pay the same amount on the commencement date, the full amount, the same as the third year. Now, the good thing about it is that for tax purposes, you'll be able to claim the tax for the full year, for the full year. And also, you don't have to worry about month to month. But the negative thing is that what happens comes the time when your loan, you have to pay for that interest in advance and you don't have money, the bank would consider that as a default to your loan. So those are the things that you need to be mindful of when it is interest in advance. Interest in advance can be a cheaper interest rate. Sometimes it will be 0.20 lower than the advertised rate. So something to think about if you want to claim interest for the whole duration of the year.
We could have told these guys this 2 days ago.
Well, that's
because we're first of the new financial year.
No, but it doesn't matter because you can settle the loan today or tomorrow, and next year you can claim for the whole year.
Yeah, cool. I always think personally, like my philosophy on this, that getting the cash in my bank account, I can use that for more deposits. So tying up the capital, you need to weigh up both options on that front. So whether
I think the risk really comes the commencement date. If you cannot come up for the full year equivalent of the interest, then the bank would consider it as a default.
Yeah, cool. Next slide.
Okay, variable versus fixed rate. Now I get often asked, should I fix or should I stay with variable? Now I always say, okay, it's really, I can't advise you with that. It's something to do with, your tolerance to risk. Would you agree? Yeah.
Yeah, like the risk, like, it depends, like, on, I haven't spoken to you about this because I never fixed file ones, and Rose has her views as well. Like, for me, like, I remember when I came to you, like 15 years ago, it was just pre-GFC. I fixed interest rates at like 8.65 with St. George, and I couldn't get out of it. And interest rates fell for like 4% and or 3.5%, and I was stuck with this stupid interest rate. I'm paying double the interest rate, and I realised at that point, how do interest rates work? Why do interest rates move in sort of fluctuations? And since then, I've fixed a couple, and I fixed them 2 years ago when everyone thought interest rates were going to go up, but I knew they were coming down and the rates were lower. And I did all right from that, but I'm not fixing at the moment because I feel the interest rates will go down further. But ultimately, I've seen, we've seen lots of clients recently that are trying to refinance, and what happens to them?
Okay, fixed rate, I think I would say, like, your tolerance to risk, maybe you have to consider that. And also, basically, if you have to fix your loan, it has to be a good fix, right?
Yeah.
It has to be a good fix to do that.
Yeah.
Now, there are things that if you fix your loan, so obviously it limits you to be with that bank, otherwise you have to break the term.
How much would it cost for a break fee? So if you fix your loan, so just for people that may not know, if you fix your loan, let's say you've got a $500,000 mortgage and you fix it for 3 years at 3% at the moment, and then you want to break it in 6 months' time and the interest rates have gone down a little bit further, just a possible, like, they're always different.
No, but in general, the way the bank calculate the break cost is what was the wholesale interest at the time when your loan started, and what would be the interest. Say, for example, you do for a 3-year fix, right? You finish 2 years, or you finish 1 year. So at the point when you first started fixing your loan, the bank would look at what was the wholesale rate at the time. And then you break it up to 1 year, so there's 2 years remaining. So what is the current 2-year fixed rate? Then they will look at, if the variable of when it was higher or lower, then they look at what is the bank's economic loss. Yeah. So it's really based on the swap. Do you call it swap?
The bank bill swap rate, the BBSR, and the BBSW, which is the bank bill swap rate.
Yeah.
So, people come in. I just saw someone wrote a question here saying that they had to pay a break fee on here. I don't know where it came up. I've got so many comments coming through and questions, so just keep them coming. There's heaps of them there, Rose. We'll
Oh, okay.
I think
I thought, how are we gonna fill the 2 hours? I thought I can just do it all in half an hour.
No, well, you're not going home this early, right?
Yeah.
We've got lots of people to answer to and to help them out. So, yeah, with it, you know, sometimes like 5 grand, 10 grand, 15 grand sort of level.
I did one recently, and the loan for 450, and there were only 6 months left. I think he has to pay around 4,200.
Yeah.
But bear in mind, okay, this is what I do for you
And
guys.
how high the interest rate is and how low it's coming to.
I'm always going to give you a refinance analysis, so that I want to make sure that if I ever break that fixed rate, you're not disadvantaged with the new rate or with the new lender. First of all, there is cash rebate now, which could
I
help.
was just about to ask you what tell us about the cash rebate.
Okay, so let's just touch why. Okay, if you ever break the fix, so there's a cash rebate that could offset the break cost.
And that's not just stuck to anyone that's doing a fix. That's for anybody.
Yeah, for anybody.
How does
Yeah.
that work?
When you refinance, if the loan, say for example, one bank offers, if the loan is 250,000, they'll offer 2,000 per security. There's also one lender that will offer only 2,000 per customer, and there's one for 3,500. NAB at the moment is offering 4,000, but the loan must settle from before the end of July.
So,
Yeah.
so technically, like if you had, say, 4 properties at 250 grand loan, so $1 million in lending,
Yeah,
and you
potentially.
refinance those 4 properties over, and you got 2 grand, 3.5 grand, or 4 grand, you could get 4 2 grands, which is 8 grand, or 4 4 grands, which is 16 grand, or 4 3.5 grands, which would be
No,
14 grand.
it's not. Okay, the one. Okay, for example, I think St. George is offering 2,000 rebate per security, but the loan must be 250,000 minimum. Then you get ANZ Bank, regardless of how many securities there, they're only going to offer 3,500 for loan over 700. And there's also CBA there, they're going to offer, I think, 2,000, and that's per client, right? So only St. George offer per security. Otherwise, it's the 2,000 or 3.5. No, okay, looking back at those fixed rate, what I was saying to you. So if I ever break, if you ever going to refinance and you're in fixed rate, I will give you a refinance analysis. Refinance analysis will tell you, like, okay, am I disadvantaged or not disadvantaged? You also have to remember, even if you get out on that fixed rate, you might be getting a cheaper interest rate. I mean, if you're fixing at 4.5 and then you only have 6 months to go, is it worth breaking and getting 2.29 and then plus a rebate? That I will give you some refinance analysis to make sure that we do understand this is what you're going, the risk of refinancing it and the advantage of getting a new interest rate. And also, if you're gonna break it because you need the equity to fund the new purchase, then maybe it's worth.
Yeah, and that's probably the biggest part, like looking at the opportunity cost. Like if you can't refinance, right? Like we've got some clients that have refinanced like 4 times this year and bought 6 properties. I can see a name that's on my screen, and I was just talking to someone, this one here, without saying the names, right? I was just on the phone to him beforehand. This guy's going from 1 property to 5 properties in a month, and we're talking about it like, you're a gangster, right? He's not a gangster, but he's like this gangster that you're, doing, 4 properties going from 1 to 5, and if you have fixed your loan, you could miss out on the opportunity of 2020, 2021. The opportunity is now, as they keep printing more and more money, making liquidity easy. The easier that it becomes for people to be able to get funding, the more people that are going to be getting funding, it's going to push up the market. As where the next boom's going to come from. So if you fix and you can't get the equity, you don't have the ability to.
Can I just with fixed rate, say for example, if you're fixed with certain lender, we don't have to break that loan if you don't wish to, but we can always top up that loan. We can increase that loan. That means you're going to end up with a fixed rate And then the top-up loan could be a variable or another fixed, but we can do that as well, provided there are equities in that loan, provided you're still happy with that bank and the rate that they're giving for the new loan. We still can, we don't need to break the fix. So it is also possible while you're there, we can also top up the loan, increase the loan. Yeah.
It is. I guess having the ability to just refinance if the valuation comes in low or whatever the case may be. Lending policy changes, you can get better options with another bank. But yeah, it depends on your personal circumstance. And what I realised and you like over 20 years, you would have realised people like, what's the cheapest interest rate? What's the cheapest one?
It's always been asked. Like I thought the cheapest interest rate now, for example, when we look at your deal, for example, this should be on the topic of reviewing your portfolio. Yeah. So what we do is
so we
we'll just continue with the variable versus fixed, right?
Okay.
Now,
remember the thought for the next
one. The variable, for example, you can do a discounted rate, right? Because what happens, say, for example, the bank would set up, okay, this is a standard variable rate of, say, 4.39. And then we negotiate, because the volume of your loan, say, for example, you have 500 to 700,000 loans, so it's worth for us negotiating for the price. We get pricing approval, and we do it all the time. When we do your loan, we just don't say like, oh, okay, we'll just default to whatever the bank gave you. So we don't do that. We make sure that the rate that the bank gives you is, we've negotiated for it, and also, you know, it's competitive to some other lenders. So when you're in a variable rate, they'll base under the package, they'll base the loan, say standard variable rate 4.39. I was able to negotiate 1.8. 4.39 minus 1.8, that would be the rate that's being negotiated. So we can do that under variable rate. Whereas this is all under the package. Whereas if you're in a fixed rate, the fixed rate, the banks at the moment in general, they're only going to get you 0.15% of the carded rate or the advertised rate. Say, for example, the carded rate or the advertised rate for fixed is, say, 3%. They're only going to get you 1.15, so you're only going to end up with 2.85. So standard variable rate, the variable rate can give you the flexibility also of being able to do 100% offset, redraw, and also if in the future you wanna switch product, like I am the variable at the moment, I can see that the interest is gonna go up, I can just split the loans to a variable and fixed. So it gives you the flexibility. Whereas when you're under a fixed rate, you obviously stuck to it, as we've mentioned before. The risk of having a fixed rate or versus the certainty, that's it's up to you. What's your tolerance to risk?
And I remember, without giving too much information, we have a staff member that is in our office, and he when the corona stuff happened, we saw the interest rates come down by the 2/4 basis point, so it was like 0.5% off, and we went back to him with one of the team, and we went and repriced what we could do with these loans, and we were able to save him $11,000 a year by just putting through an email to the bank with his portfolio and putting a repricing as well. So you don't
I think we can touch that on the when we review the portfolio, because yeah. So okay, I was just gonna touch base on the assessment rate, variable versus fixed rate. When we do large application, I've never used the fixed rate. Only the reason, if the servicing is very tight, fixed rate assessment rate is higher compared to the variable rate. In general, for example, we have negotiated your interest rate. Say, for example, the negotiated interest rate is 3%. And then the bank said you need to put 2.5 on top as a buffer. So that means your assessment rate is 5.5. Whereas with fixed rates, say, for example, some bank would base it to the standard variable rate when you come out from the fixed rate. So if the variable standard is 5%, then they put 2.5 on top of that. That means the assessment rate could go up to 7.5. So if the servicing is very tight, we use the variable rate. Now, also, if you want a fixed rate, you think, oh, this is really a good rate, I need to fix it. So you need to lock that rate. And when you lock that rate, they may charge you $750. You can lock the rate throughout the loan process, right? So it doesn't have to be at the onset. It could be in the middle or prior to approval, or when you lock that rate, you have 90 days that the bank guarantees that is your rate. Now, say for example, you lock that rate at 750, and come settlement, the rate is lower than what you have locked. We can also unlock that, but they won't refund you the 750 or whatever it cost you, but then you can use the new fixed rate.
Yeah. Cool.
Yeah.
And I'm sure there's questions in there asking you predictions of interest rates. So
that's for you to predict.
Move on.
Yes. Yes.
Cool. Where are we? Here we go.
Okay, this one is a review of loan portfolio. I have seen a lot. The way, I'm not saying mostly, sometimes it happens if you go direct to the bank, the branch, the way you do it, they just cross-secure your loan, right? It happens all the time. I get
so bad,
right?
Bad.
So many 5 properties cross-securitizing. Now, when I review a loan, I would probably ask some of the questions. So then I would suggest, do you want us to unsecure them? Because it's not really, the reason being, if you have to cross-secure that loan, say for example, you want to sell one of those properties. So the remaining loan balance, the bank would ask, is the security enough to cover the remaining? So they have to revalue those 4 properties. The up and down of the valuation may not be enough, right? At the time when you did the loan, it was okay. So you have to put in some money out of your pocket for the remaining, to make up for the loan versus the security.
And a few years ago, I had a client which had a terminally ill person that was related to him, and they wanted to get some funding and whatnot. They came and reached out, but weren't able to maneuver because if they sold the property, thinking they could get the capital, but they couldn't because the bank had structured them in that way.
Yeah.
So it gives no flexibility to the borrower, but to
and also when you do cross securitization, your home loan, for example, is cross secured with an investment. I mean, there's a nightmare of administering which one. Okay, this is my home. I cross securitize. I mean, your accountant would always ask for a statement, right? Unless you have a paper trail to say, like, look, all of these owner occupied that I have, some portion of these are investment, some are owner occupied. So which one is which? So you need to look at the paper trail, and it is also a nightmare when you prepare your tax return.
Why would a lender cross collateralize your property?
Because most of them, I've noticed some brokers are just not lazy to do it. Like they think, oh, this is easy. Look, don't worry. It doesn't matter. All the loans belong to you. So who cares? And mostly the brands as well. I think so. I'm probably very skeptical about it. I think sometimes the brands will just do it so that you stay with them.
The more control. Like lately, and well, we've never actually discussed it, but I always say the same thing, right? Comes straight out of my mouth. The bank. So I look at them like, this is dodgy. How it's being set up. Someone's like screwed you over because it's all. Like I talk to them like, I'm doing a map session or whatever, and I'm like, your portfolio doesn't add up. Tell me more about it. I'm like, your loans are all crossed, aren't they? They're like, oh, I don't think so. And it's like, yes, they are. Or they go, yeah, it is. How do you know? It's like, so I can see a mile away that you.
Yeah, but not only that, right? Say, for example, you're using your home or you access some of the equity for your home to fund the investment. Now, it's also a good thing as well, like, okay, we need to free your home loan if possible. So when we review your loan, we said, okay, we do have access to RP data. We have access, and we look at, oh, maybe this property is worth this much. So if, for example, we increase this investment property or refinance it just to get the equity and maybe pay out some of the loan that was used on the home loan.
Yeah.
So that sort of thing is really beneficial, because then you say, oh, thank God, my home loan now is on, instead of having 600,000 loan, I only have 500, because the investment property now was able to generate equity to cover the source of funds which we have used from the owner op. Now, also, I always believe that if your loan has been with that lender for at least 3 years, it's time to really look at it if it's this interest rate still serviceable for you, or are you getting a good rate?
Has your lender given you all the reductions that you should have had whilst they dropped the
Yeah.
rates from 7% down to, you know,
And
2%?
often this is what we come across with often, right? The bank the lenders would give you a cheaper rate if you are new to the banks, like new money.
They're trying to,
Yeah, new money. So if you've been there for 3 years, 4 years, they seem to be forgotten you.
Yeah.
Unless you really kick your, you know,
you
really be vigilant about asking the bank, I want a lower interest. So that's when you negotiate the interest rate with the bank. If you're not going to be, you don't want to be you don't want to have refinance, or you want to stay with them. But honestly, if your loan has been 3 years of the same lender, you need to be reviewed. It doesn't have to be refinanced, but it could be time to negotiate your interest rate with your current lender.
Looking at it from that perspective made me think about a client you recently helped out, without talking about the names of that. You know, the person that we jointly helped out before he came on board, and he refinanced about 5 mil, and
yes, we did.
And he saved about 60, 70 grand a year. So
yeah,
that's like a whole salary.
Yeah, I think what we did with that, right? There will be instance that servicing is an issue, so we mix the loans. Some of them are P&I, some of them are interest only, just to fit into getting a better lender for you, or negotiating a better interest rate. So we do come across that is a success story, because he's very, very happy of what you know, when we reviewed the loan, and it was a lot of savings.
Yeah, 60 grand. That's like,
yeah.
I know people that hop on the train every day, go to the city, catch a train, wake up at 7 o'clock in the morning, get back at 7 o'clock at night, 5 days a week.
Yeah,
and that's a whole salary.
I mean, it makes me feel so happy that I was able to help them. I mean, they're so grateful.
And that's sort of like what we specialize on. People want to know, you know, what does Zinger Finance do, and how can we help them, and whatnot.
Definitely with Zinger Finance, we don't take things for granted, that's for sure, right? We always review, like, if you come on board and you get this portfolio, we just don't say like, oh, okay, yeah, we'll just do that. We look into your servicing, what are the lenders that would fit in you, we negotiate for the rate, pricing approval. We do a lot of work just to get that, to make that happen. We don't just say like, oh, okay, that's all right. It's you know, we'll just give him that. No, it doesn't work that way. I definitely don't do that, and my staff, my team would not do that. I mean, since I come on board, I am very vigilant that make sure it passed to me, and I said, have you done this? And show me. I do random audit with what they do, make sure that is it really for the best interest of the client. So, you know, we do look after you.
Yeah, and looking at, like, I've talked a lot about debt strategies and whatnot recently. I think it's important, like, that we're not looking at, you know, the property that you're acquiring today or your portfolio today. It's important to look at that, but we need to look at, like, if you're buying your second property, it's not just a second property. It's not the third property that we're going to look at. It's number 6, 7, and 8. And it's like, how is this finance, how is this debt going to fit into the overall plan to help you down the track? Because lenders are all different. They have different servicing calculators. They have all different ways of assessing the loans. I think it's important that you know, a lot of people just go out there, they buy 1 or 2 properties, they get stuck, and they're like, what do I do? And they could be crossed. They could be, you know, how many people do you see on a weekly basis that are?
Oh, I see all the time that the popular one is cross-secured.
Yeah.
Yeah, and also, okay.
And fixing
as well. And let me touch this one as well. With your loan repayments, for example, right? You pass the 5-year interest only or 3-year interest only when the loan first lodged. So you're now going to principal and interest repayment. When it goes to P&I, you have like 10 properties or 6 properties. Cash flow is always a problem, right? Because you're now moving to a principal and interest repayment. That's when probably the time that you need to ring us or tell us, just keep in touch and say, can you just look at my loan portfolio? And we obviously do a lot of work on it and make sure that, yes, we can recommend this. We could go back, because being an investment, we could go back to interest only. But sometimes the bank would limit you to 10 years interest only or 5 years interest only. If you made already 5 years, sometimes they won't let you go more than 5 years. Some banks would let you go up to 10 years. But the problem with going too long for that bank for 10 years, then the problem is once you come out from a 10 years interest only, the amortization of your principal and interest there'll be only 10 years left, right? Because you've used the 10 years as an interest only. So why would you stay with that bank and then, you look at they were going to be amortizing my loan only for 20 years. And then if I move to another lender, I'm not churning anyone, right? I'm just saying I'm not saying okay, you have to refinance, but this is also things that we need to look at. If your repayments interest only has locked for 5 years, if that bank would not allow you to extend for another 5 years, then you're going to be paying principal and interest. Is principal and interest really achievable for you? Is it
in your best interest, like you got?
Yeah, and also cash flow wise, can you service the loan at principal and interest repayments?
10 let's say 10 properties and you're paying $80 a week principal repayment, that's $800 a week. It's 40 grand a year. Most people are getting a JobKeeper now anyway, but that 40 grand a year, that's the difference. So can you restructure that debt for the future? What maneuvering can you have? Can you do a security swap? There's things that we're probably
okay. Let's touch on the it's called portability. I don't know if you heard about portability. It's one of the features for the product that, say, for example, standard variable fixed rate. They do provide portability. I don't think there is a portability for a basic home loan. So that particular features can be in some of the loans. Say, for example, you want to maintain the accounts. You have account 1, 2, 3. I have this property worth 1 million. I want to sell it because obviously 1 million, the rent for that is only 500, because people can only rent as to how much they can afford. 1 million property doesn't give you 10,000 a week rent or whatever it is.
Yeah.
So it's only, they can only rent as to what they can afford. Now, then you look at your strategy. Is 1 million with one property with $500 a week rent, is that suffice? So what happens if I can buy with 1 million, I can get, going back to the first question, that I can buy 3 properties on that, and maybe I can get a better rental income for those 3 properties. And if that's the case, and you want to maintain the particular account, so what we do is that, well, if you want to keep that account, we can do portability. But portability is a bit complex in when we do administer it. It has brokers. I would recommend it has to be experienced broker, because there is also, we need to look at when that loan was first lodged, right? What was the value of the security, and what is the loan value at the, because portability, you cannot change anything on that. You cannot change the loan amount. So when we settle that loan, for example, so we look at this outgoing property and incoming, it has to settle simultaneously. The value, that 1 million that's going, and the value of those 3 properties must not be lower than the value of that 1 million property when they started, right? So the only negative about it, those 3 securities has to be cross-secured, because it's replacing one account. This is probably when the cross-securitization is probably, we can't avoid it, right? Because that's replacing the account. But
on last Friday, I helped an outgoing sale, assisted, not from the outgoing side, but an incoming person. There was a deal of 16 people approximately
involved in this one transaction, right? So what I mean by 16 people is a whole block of units all had to settle at the same time as an outgoing, had a whole pile of new properties coming into the deal, do a security swap, and we basically took the engine out of the car. Imagine the car driving down the freeway, and we took the engine out of the car and changed the engine whilst the car's driving down the freeway. That's what we did with a portfolio. And I'll be doing a Facebook Live and some YouTube videos and filming it on Friday in this office. We're going to get the whiteboard behind us. I'm going to get my lectern out, get a bottle of scotch out of the cupboards, even though I don't drink all that often. It's a celebration, so we need to celebrate because it's one of the coolest deals. And the investor's going to come in. We're going to draw on the board and actually run through what had occurred. So keep an eye out for that. I won't go too much into detail with it at this point in time, but from 2 properties going up to like 9 or 10 properties in a day, you can really, if you have the right debt facilities, these were really, one was a wonky sort of loan facility, was the lender that doesn't have much parameter to move with. One was with an okay loan setup. Generally, a broker won't assist in that because they're not getting paid for the loan deal to go through, and there's lots of moving parts, and it could all blow up in their hands. So to date, touch wood, every single one we've been able to nurture through. You've got properties that are being taken out of the equation, properties coming into the equation that have all got to settle. The respective banks need to come in to purchase the outgoing property, and the banks to let go of the incoming properties all have to be at the table. So sometimes it could involve
it's a lot of work.
16 people. Yeah.
Portability is, I don't know, I feel like you have to be an experienced broker to do portability. Some of the new brokers there, they don't even understand what portability is. It's very seldom used, but I think now that you know, it's probably worthwhile for you if you are an investor. If you want to replace one security that is one of your properties that is not performing, and yet and you want to maintain that loan account, then portability could be your answer.
So basically, before you go to sell off a property, reach out to us. Obviously, we're not financial advisors. Give you financial advice to sell or not to sell, but we can look at what options there are if you were to sell that. There's so many people that feel that they can't service today, but they could potentially serve it. They could be able to swap the security and really reshape their portfolio without having to take on new debt. They could sell off an asset, bring that capital in, acquire new assets, and even purchase properties cash with the buffer. So we'll get to that in a moment. So we finished on this slide. We're finished with portfolio.
Well, okay.
We'll take some questions.
We'll take some questions.
Take some questions because we're getting close to that time. Tamim asked, if my partner and I have a joint bank account and she accesses her super, would it impact my loan application?
So joint partners? Okay. So for example, now when you do the loan, is it only you, your partner is not going to be there?
Well, it's not going to pop up, the question not going to pop up here straight away. We've got like the whole screen full of it. So there is variables.
Okay.
But if the bank accounts are joined, you'll see the money coming into the joint bank account anyway.
Yeah, that's what I'm saying. Say for example, so if it is a joint account and then one of you going to apply for the loan, would it impact your servicing or your ability to borrow because your partner has access to super, right?
Yeah.
Now, the question is, will you be the only one borrowing the property? Is your partner be a borrower? And if she is one of the borrowers, then of course it will impact. If, for example, if you're the only borrower and it's just happened that your bank account has been hit by that super access of the superannuation, we can always prove that it wasn't you, it was your partner.
Yeah, cool. On that, case by case, I guess. So reach out to Rose. So I'm assuming I can see little messages here. Get Rose to contact me, get the team. So I'm sure that everyone wants to reach out to you after this. But I'll give you guys the details how to get in contact with Rose after this. Another question here from Hayden. My wife and I are yet to begin our home loan repayments from the house we built last year. We are yet to begin paying repayments as we're only about to finish the drawdown for that loan in the coming weeks. Could this affect how soon we could access equity, and would we still need 6 months worth of repayments, seeing as though we haven't begun that?
Okay, so this is, if it is a construction loan, they must have a progress payment schedule though. They must have paid for the progress payment.
There would be a record of something there.
Yeah. So it's not, there will be a history because, okay, for instance, if you have of your building, that means there is land and construction, right? So obviously, once the progress payment starts, you start paying the loan. So, I mean, there is a 6 months history there at least.
Yeah, but it has to be on the lien component. You'd have it as well.
Yeah,
so,
you have, unless you build and construct with no loans. So
yeah.
if that's the case, we can always, there's always 100% equity there. There's no loan attached to it.
But if it's accessing equity, like if the property has equity, then your loan is in serviceable order. So your mortgage repayments are on track, your payments are up to date, you're always paying on time, you've got your servicing, you get the loan and whatnot, and you've got equity there.
Yeah, we can, okay, put it this way, right? We can always review the equity. I mean, we have access to RP data. That RP data will give you an estimate of the estimate valuation of your property, and then we look at, then we feel, okay, potentially there is an equity for this property. Now, before we can do upfront valuation. Now, when we do upfront valuation, we have to make sure that we have the full intention of lodging that loan with that particular lender. Because if you don't, just for the heck of getting the valuation, then the bank will not be happy with me. So say for example, okay, I look at the RP data, your property is worth already 600,000, and I thought, okay, I look at your servicing, I look at, okay, you can do AZ Bank, for example, or Commonwealth, or St. George, or NEB. So I can order a upfront valuation. Then I can do the upfront valuation, but I must have a full intention of lodging that loan with that particular bank. So yes, every property has a potential of having an equity, and we can determine that once you give us the address of the property. We'll search it, and then we'll see where you can borrow. Then we'll do a front valuation.
Working on strategy.
Yeah.
Jared just wrote, is it normal for your branch manager to write you a card in the mail saying thank you for letting us make your banking magic? Hope your family is well. Lol. Maybe they know I'm refinancing and don't want me to leave their bank.
So this is the challenge with us for refinancing, right? I mean, when we do refinancing, when it comes to settlement, sometimes then they have this called retention section. The bank always have the retention section. Now, when they will be notified that you're going to be refinancing, they will contact you and they would say, hey, you're refinancing to that lender. What interest rate are they giving you? We can offer you the same as what they offer you, and we can even throw some cash with it. So we could be doing, and then you may say like, look, I don't want to refinance because they're gonna give me the interest that they gave me. So these are the part of the brokers that we do that we may not be paid. So so who's gonna pay us? So I guess that's just bad luck for us.
What's this for?
Sometimes when you refinance and then the outgoing lender would retain, there's a retention section there. They would say, don't refinance, we'll give you the same interest what the other bank give you.
Yeah.
And
but this is coming straight from the bank itself.
Yeah. They give you that letter, right?
Yeah, trying
to sweeten you.
Yeah, trying to reel you back in. But ultimately the loan's got to be able to do what it needs to do, and pulling that equity out and having the right structuring is crucial. And yeah, just very interesting that you got sent that. So yeah, they wouldn't know at this point, like
no, because what happened, I think one of the banks that I know, right, and once the loan was approved, they haven't even issued the loan documents. They've already notified the outgoing lender that we're going to refinance this. Yeah. I mean, I think there is a bank, I think it could be a rapid refinance, like for example, I think Westpac, they can do rapid refinance.
Yeah.
That means, you know, the outgoing lender doesn't have a chance to retain you because they just,
yeah.
quick refi.
I'm just writing here an email for the next person. So I just saw Josh's message and it said, this is amazing, mate. Glad we joined B.Invested, and I look forward to helping you reach your goals, Josh. And I just actually messaged your broker just there to follow up something. That's why I put the phone out. So thanks, mate, and humbled to be of service for you. So Steve just wrote here, is it right for me to believe that with rental caps on most lenders, that every property purchase will be lowering your borrowing capacity, irregardless of it is positive or not? If so, what is the way to continue borrowing to build a strong portfolio? Must you fall back to rely on capital for outright purchase, etc.? I caught up with Steve the other day. I might answer that one on your behalf, and then maybe if you want to jump in as well. So with it, looking at the rental caps on servicing. So if you've got a 10% yield and you're purchasing it, and the bank caps it at 6.5%, suddenly that yield isn't being captured, and your cash flow is bleeding out of your position. There's a few ways around that. Obviously, the big four banks are the ones that
either is a yield cap.
You can go to a second-tier lender. Is that right?
Yeah, you can do second-tier lender. I think Rose Renouf doesn't have cap. We've been using them a lot now.
Does Macquarie have a cap?
I don't know. I haven't read Macquarie. Recently.
So each lender is different. So some of them will have the cap, and some will not have the cap. One way could be that you could purchase it cash outright. Obviously, we spoke about a property recently, which was like a 50 grand purchase, rent for $30,000 or $25,000 a year. It's about a 50% return on investment. If you're buying it cash, then the bank wouldn't, necessarily be able to impose that, because they wouldn't have a loan, they wouldn't know anything about the purchase, they'd just be able to go off the cash flow. So structuring, some of the purchase, whether they be cash purchases or whether they be with a loan, which lender do we take that asset to, all comes down to navigating through. And I'm really excited about the plan that we put through the other day, to push you forward to your next step, Steve. But yeah, I personally feel that once we get the next leg of the portfolio out, I think we can get another, the other day, another 6 or 7 properties, principal place, maybe 12 properties. Without the principal place, he's got a good position there. We just need to tweak. We need to sell off one property, restructure some debt, roll it over, and then give the runway for the next leg of the portfolio. So at the moment, he's not with the big four. He's got some with the big four, but some with second-tier lenders. We're going to dispose of one asset, purchase 2 properties outright. So he can't buy anything at the moment. We're going to sell off a block of land, purchase 2 properties cash for like 100, 150 grand each, use that cash flow to service and get all the properties refinanced back to the big four, reduce the interest expenses by maybe 20 grand a year from some modelling, 10 grand, 20 grand a year, depending on the day, and then be able to purchase another $800,000 worth of asset with the big four bank. And then we've got those 2 properties, because we're going to be able to pull equity out as well when we do that refinance to the big four. And then those 2 properties that we purchase outright, we're going to use them to be a deposit, like we get a loan with the second-tier lender, and then take that 300 grand, 250 grand, whatever it is, and use it as a deposit, either buy a $1.5 million house with it, with the second-tier lender, or purchase more investment properties with second-tier lender.
Yeah.
So
I can. I don't want to discuss it here, but there's a way.
Yeah, there's all different ways to be able to structure the everybody's position is different. So I feel like I was like telling everyone, talking about this cool strategy, and it's like a lot of people are like, oh, what can we do with our strategy? What can we do with ours? So feel free to reach out to the team. We're here. We're inviting and here to help. So we'll talk more with the strategy, Steve, offline as well. Angela, I bought my first property using owner-occupied loan. Now I'm planning to upgrade and buy a second property. for own and stay, and rent out the first house, can I apply for another owner-occupied loan for the second property at a different bank?
Okay. Okay, so you have an owner-occupied property, and then are you going to turn that into an investment, or you just want to make sure that you purchase another investment property, making that an owner-occupied because for loan purpose, for interest rate? That could be, that's the only reason that you would want to do that, right? Because interest rate is cheaper than the investment. So what he was saying, I get an owner-occupied now, and then I would say I will turn that into an investment, and we go to another lender and buy another property as an owner-occupied. Yes, you can. If the first owner-occupied, obviously, we're not using the same lender, and if you have, genuinely turning the first owner of property into an investment property, your second investment property can be a second property, could be an owner of.
Yeah, and it depends, I guess, coming down to intention as well. Like if
Yeah.
you're moving out of the first owner occupier to upgrade, you don't know what you're doing at the time. You go and purchase the new owner occupier, and then you intend on selling the property off, like,
It happens all the time. When I come across with it all the time, where the first owner of property, we turn it into investment property, and then we'll just tell the bank, and we'll look at what would be the rental assessment for that property, and the new property will be an owner occupied.
Yeah. What is your opinion on the potential reduction of house prices up to 30%? And I really wish that drop by 30%. I wish property prices would drop. Imagine
Do you think, can I ask you a question?
Yeah.
So after the September, where you have the 750 JobKeeper,
yeah,
potentially the prices of the house could go down because there is.
I would love it. I would love it to go down. But the problem is that this recession wasn't because of this scam. I don't want to pollute our nice finance webinar with thoughts about system and whatnot, but you asked me, so it's opening up a can of worms here.
You could have told me, like, do not ask the question.
No, it's good. It's good. You remember maybe 18 months ago when we went and had lunch, and my mum came along. Well, she came along to drop off some mail to me.
Yeah.
And I think at that point I was telling you about, we're in a recession. We're going to recession. We're in a recession.
Yes.
Things are going to go crazy. We hit there and went into different levels, and the market imploded in September last year, around September 11th to 18th last year, when the repurchasing agreements of the central banks buy up the bank's balance sheets for overnight lending, interbank lending, and they've been trying to revive this market for many years now, like 2 years, 18 months, 2 years now. We're at a point where it's off a cliff, and we have got interest rates almost at zero, high chance of potential going into negative interest rates, which is great. And they've done this to stop a potential recession. If they just rip that out from under the rug, and I talk about this on my Tuesday nights, then we remove this, suddenly the whole market's going to die, right? I believe that we're stuck. It's going to be packaged up in some form of universal basic income. We need to get liquidity floating around the system. Best way is to drop it down to people and let it flow through the system. I believe JobKeeper and all these things will be extended. Different sort of formats may arise of it. If they took it out, it would cause some dramas. There'll be businesses that would be like, I don't need these staff anymore, let people go, would enter the second phase of the depression. But I believe that this is a deflationary, in this current monetary system that we've got, debt needs to keep expanding for it to be effective. If we have contraction, i.e. deflation, it's going to impact in a very, very bad way. It's going to blow up the system. So they need to keep printing money. And we're at a point now where at 0% interest rates, there's not much left in the system to keep manipulating this factor. We're going to have a hyperinflationary depression, in my opinion. So they're going to just have to keep printing money, which will have different sort of effects in the economy. It'll lose the value of the currency in the end of it. So I don't normally go around the office and go deep into Rose with you, but I believe that
some markets will get hit. The top end of the market will get hit. In some areas, it has been a little bit, volatile, especially like in the inner city Sydney and stuff like that. But a lot of the bread and butter sort of areas, remember, out of everybody here that's watching this evening, you guys didn't know me, before I quit my job. Rose remembered before I quit my job, and looking at the way that the properties work, like in the last boom. You remember when the boom sort of started out west, and came inwards. Mm-hmm. And when I quit my job, and I used to wear, you remember the days when I used to wear very polished and had a tie clip and cufflinks.
Like really, you look like a car dealer, a car salesman.
Oh really?
With a tie. Oh, I don't know. Is it what a car salesman looks like?
You told me I looked like someone off Suits or something, like a lawyer.
A lawyer.
Yeah. Car salesperson.
Yeah, but you were selling car at the time. Maybe that's where I associate advertising. Yes, yeah. With every Wednesday, it's called Trade.
No, so it was the newspaper.
Magazine,
the Cars Guide. Cars Guide I worked for. I forget who I worked for beforehand.
Yeah, Trade. There's a newspaper Cumberland called Trade, or something like it. It comes out every Wednesdays.
Oh, I think I know that one. I forget the
Trade. Yeah.
Yeah, I don't know. I can't remember. I didn't pay too much attention. I just wanted to get my paycheck, bring it to you, get a loan, and keep building that portfolio out. But in the market at the time, what we saw was the bottom end of the market took off because there was high yields in the market. The rental returns were strong. We saw volatility at the stock market. We saw volatility in other areas of the financial markets, and it was the midst of the GFC. And I came in and I was, quitting my job. My payments aren't working anymore, and my portfolio turned positive cash flow because I built that base out. And some areas will benefit very well in this market. Some will perform poorly.
I remember you said, "Can I use my credit card for the deposit?"
I tried everything.
You tried everything.
And with when I was able to quit my job. I realized that the properties were purely just a vehicle, in order to get me there. And I think more so than looking at is the market going to fall. Certainly, what I'm experiencing out there is very annoying. As I'm negotiating deals and locating them, there's a lot of buyers out of the market. We're getting gazumped on properties. The lower end of the market. There's investors that have pulled the money from the stock market, people that have got access to cheap money. What we've got to remember, and I talk about this a lot on the Tuesday night chats on Facebook and Instagram, is that someone may not have been able to service with the 7.25% cap that Apple put in 2 years ago. Someone couldn't service at 5% interest rate, but now at 2.5% interest rate, they could service potentially.
Potentially, yeah. But but sometimes, but look, there is a trade-in. This current market, obviously, the expense, the living expenses. Never used to have the living expenses. You just declared how much cost you to live. But nowadays, there is a benchmark of it's called housing expenditure measure. Yeah. So that's probably sometimes brings the servicing.
And I think the more liquidity that's floating around the system, it all starts with finance, because if there's no access to liquidity, the market's not going to move. It's going to seize up. If there's liquidity flowing, it's called currency, right? It's like the currents when it comes through the ocean, currency when it comes to electricity, currency as we're using this currency. The more momentum it has, the more effective it is. And I guess the benefit of owning a finance firm, and hopefully one day a bank, we get to see at the back end, trends and movements and how, the currency is flowing out there. And at this point in time, I don't see anything that warrants, a drop like that. I've seen a lot of these doomsayers that come out and they're like, the market's going to crash and all this sort of stuff, their stats and that. They leave half the stuff off the table. They have an agenda for selling gold, silver, and shorting bank stocks and whatnot in the market. It's something that's been out there for the last decade. So do I think the market's going to fall? I said the market was going to get hit in September of 2016, but not right then. We saw it happen around late 2017, 18 and 19. We started to see the market recover in the second half of 2019 after we saw interest rates on monetary policy go to an easing angle. Was in a quantitative tightening phase for a period of 24 months prior to the middle of last year, and we've seen monetary policy in an easing trend since then, and that's when we started to see the market pick up in the middle of last year. So I don't see it dropping by 30%. The market did drop maybe like 10-15% in capital cities 2 years ago, and it certainly made up a lot of ground to get back to where it was sort of at that peak still in 2020. So interesting times. Now, Michael, in a market expected to drop significantly, do you see a 10% deposit on a purchase in the next 6 months as a risky decision? Does this leave you exposed to potential negative equity in the short to medium term? Good question. I sort of just, that was a good question to come off the last one. I don't see the market dropping. In some areas, it could possibly do that. But as I said, like the markets did drop, in Sydney, a lot of areas dropped sort of 10%, 15% 2 years ago, 3 years ago. Do I recommend using 10%? As I said beforehand, majority of our loans here at 80%. And the reason being is that it gives you more flexibility. It's how we structure the debt, how Rose and the team put together the finance and debt accumulation strategy and consolidation strategy to ensure that those loan facilities are working best for you. If you're using a 20% deposit and you're buying it below market value by sort of 10% or 20%, then you've got a long way to go before you start hitting that negative equity point. I always talk about buying it below market value, upside for capital growth, and a strong cash flow. If you're buying something so far below market value, a war would have to happen, or something would have to, hell would have to freeze over before we saw it go down negative equity. But I do see, a lot of potential out there. People buying stuff at retail prices or over retail. I do see risks that occur in different areas of the market at different times. And obviously the banks will factor that risk as well, and they may say we're not going to give you a 10% deposit in such a neighbourhood that could be a high risk as postcode restriction. Maybe
postcode restriction, yeah. If it is an LMI deal, it's a bit difficult.
Yeah. So when you're using a 20% deposit, it's you dealing with the bank. The bank may say yes, you can borrow. However, at a different point, you might say, I want to go to a 90% deposit. The bank may approve, you might be ready to go with the terms. You bring the lending mortgage insurance company in, they put their terms and conditions on it. Then suddenly you do it dealing with you and the bank, and now dealing with the third-party mortgage insurance, and they put,
And also it's difficult to refinance that loan, because I will never refinance a loan that's currently with an LMI deal. You're just going to move from one lender to another lender. Potentially you can get you will have to pay another LMI again. So I'll probably be stuck with that lender if it's a LMI deal, because why would you move? You move to another lender, you could be paying another LMI.
Yeah. Exactly, and that's the importance I saw here. So you can't use a deposit. Braden asked, you can't use a deposit for investment properties. He said you can use a 10% deposit. We're going to catch up tomorrow for a map session, so we'll have a chat about your position.
It doesn't mean, it doesn't stop you from. What it means is that 10% deposit is basically, if you can afford it, do 20%. Otherwise. 10% is also, we can also do it, but there are some disadvantages in terms of in the future you may not be able to move because your deal is always going to be a mortgage forward.
Yeah. I've got a question here from Luke, which is a good one. I'd like to answer that one for you. Question on a LVR. I can get loans at 90% LVR, interest only, no LMI, because I'm a chartered accountant. Should I ever consider going below 90% LVR, as I would like to retain the working capital? What's the benefit of going below 90%? Nathan looking sharp. I'll answer the one because
the compliment instead of looking sharp. Thanks, mate.
So he deserves the answer from you.
Deserves the answer. No, I don't know. Look, if you're in a special field, so what are the special fields where you get 90% no mortgage
I think
insurance?
no mortgage insurance, yes.
Yeah. So like doctors, lawyers, accountants.
What I understand is that is only, yes, you can do with investment as well. Yeah, doctors, medical,
Yeah.
chartered accountants.
Yeah, accountants, lawyers, any professional service, what everyone's parents teach them to go do at school, go to uni, become a doctor, lawyer, or accountant.
It pays off, isn't it? If you don't know.
I know, sometimes I'm just like, I'm going to go down to Zenith Legal, I'm going to go work with Steve, I'm going to go get a law degree, I'll refinance my whole portfolio, get out extra, and claim that. Looking at the going for 90%, if you're not paying mortgage insurance, if you are in one of those specialized fields and you don't have to pay mortgage insurance, why not?
Oh, yeah, take advantage.
Take advantage of it. Then you've got more working capital. You can then, like, the main reason why is that you have to deal with the mortgage insurance company. When you're dealing with the mortgage insurance company, you have greater restrictions, and if you can't get the loan structure that you need and you have to take it from one bank to another, you would have to pay mortgage insurance again. If you're not paying it, well then, it's better to have that cash in your pocket. So that is something there to consider. If you want Rose and the team to look into that and give you a bit of a debt strategy on that, Luke, reach out. We actually do specialise. I've got some team members. We specialise with doctors and medical fields. We've actually got an area of business where we specialise in that sort of stuff. So happy to help out where we can. Apparently we lost some audio beforehand and we came back. Hi there, with a block of units, what LVR does your private lender apply? Most of the banks are only lending at 60 to 65%. Fabian, I'll leave this one for Rose, but I know that we're speaking the other day, some of them are up to like 75 still, are they? 70?
Well, how many, first of all, you can do traditional lending for it's called dual occupancy, right?
Yeah.
For in a building, or say for example there are, okay, for example Pepper, for example, their policy is you can only do 3 or no more than 25% of the number of properties there. So whichever is lower, I guess, yes, you can do private lending for those.
Yeah.
But then again, the postcode restriction has to be considered.
Yeah. Exactly. So reach out, Fabian, on that note. Alan, hi Rose and Nathan. My current salary is cut by 20% until September 2020. What would the lenders take my normal salary or the lower salary?
The lender would take your lower salary because there's no guarantee that
Yeah, gonna get it back.
You're gonna get it back.
Craig, would you recommend borrowing for a primary residence, not the first home, with 5% deposit? Case by case scenario, and you got to weigh up the benefits of each way, I guess.
Oh, okay. This one. Would you recommend borrowing? At the moment, it's hard at the moment. The topic, I don't know if I understand the question very well. If you're a first home buyer, you get a 5% genuine savings. And if you're a citizen and you're buying, there is a cap of how much you can buy. Say 650, you have a free stamp duty, you get the free mortgage, the government would guarantee the mortgage insurance, and also the bank, obviously there is a queue, right? Because there's a limit, only 10,000 I think, and out of the 4 banks, only CBA and National Australia Bank were awarded with that kind of the LMI waiver. So if you're a first home buyer, you get a 5% genuine savings. You should apply now because there's a queue, and there's My State Bank for non-prime lenders would do it for you as well. I think Gateway, but with the 4 lenders, only CBA and National Australia Bank are awarded.
That's why I asked you before. How many lenders are there out there, right? Like there's lenders that we can rattle off, right? We've got like Trove, Bluestone, First Mac, Resi Mac.
Gateway. There's also one 866-400.
Oh, yeah, that's the second in the day or something. That's a neo bank. It's a new platform. Yeah.
The one that's really good at the moment is in 866-400. I don't know. I haven't read it.
Yeah,
But
86,400.
Yeah, something.
It's
There's
second
so many
in the day.
there. Yeah.
Where will we go next one here?
Do
all lenders require someone to be a permanent employee as opposed to a permanent casual?
Okay. Casual employees are also considered. Their income is considered 100%. So yeah, there's no discrimination with casuals. I mean, there are lenders that would take casual at 100% income. Assess their income at 100%.
There's a lot of questions here. I think we should just like pump around, try and give like half a minute to each one.
Yeah.
Matt, if I've just registered a new ABN for contracting services, how long should I wait before refinance to maximise the serviceability with the banks?
No, they basically want you to be a self-employed for 2 years. However, they can, some lenders could, if you have a complete financial for 1 year, we may be able to find you a lender.
What about those people that are on payroll companies? Those I think those are like floaters group. I don't know much about those payroll. Like if someone's a contract and they're getting the contract is paid by a payroll company. Sometimes the banks will take them.
So if you're a contractor, for example, the bank would review as to how long the contract. It must be if you have like say 12 months left, they would consider that income. But contractor is different from casuals.
So
because contractor has a fixed term, I think.
Yeah, true, exactly. So case by case, if you want to reach out, Matt, reach out to the team. They'll have a look over your position and be able to go further in to see what options there are for you. I think it's important never to accept no as an answer, guys. Like if you don't feel comfortable, just keep asking and keep seeking and trying to work out. Like a lot of people in here are looking for questions, and I hope that we can get through them all. A lot of people feel that they're sort of stuck. Their bank won't allow them to do something or do like.
So it doesn't really harm to call us, right?
Yeah.
You'll never know. We may be able to help you.
Exactly. David said, don't forget you can break the fixed rate loan agreement. If it's less than $1,000 today, they give you the cashback at St. George or Suncorp. So there is cashbacks, that's what Rose was talking about beforehand. Steve, principal interest versus interest only loans, which is better for investment property. We talked about that beforehand. Obviously,
interest only for investors.
What I find amazing, this is what I find from some people, it all comes down to like mindset and strategy. Building, and I've always said from day dot that it's sort of like building a business, right? When you're building a property portfolio, you need to treat numbers right. A lot of people just go, oh yeah, I want to pay down my debt, right? And they'll get a loan at 250 grand. They'll try and pay down, $50 a week, and they screw up their cash flow. They've got 5 of them. They're trying to pay them all down. They're like, I want to pay principal and interest, but next minute they go back to the bank and they're like, oh please, can I get some equity up? It's like your loan's just gone, you've struggled your ass off to get it from 250 to 230 grand in the last 3 years, and now you want to go refinance it for 300 grand. It's silly. So I think you need to have that strategy. It's the importance of working out the strategy as to, are you in an accumulation phase of your portfolio? Are you in a consolidation phase? Where are your goals sitting at? Like your goals to, have 10 properties in the next sort of 12 months, or having 10 properties in 10 years? Is it to get 50 grand or 100 grand a year passive income? Or, have you got the 10 properties and you want to pay down that debt? Are you at a point where you've got 2 properties and you want to get to 10 and you need to be on rapid speed of accumulation? What phase in your portfolio you're at, and what works best for you at that different phase? And that's where the team helps out work that plan and devise a plan. Hi guys, what LVR do banks on a property, shop and unit that is owned by a trust? I'm assuming that would be classed as commercial.
If it is okay, there is a very good lender at the moment for commercial lending. No more than 1 million, you can get a low doc for that, and I think they can do 80%. This is one of the main banks and the best in the market, I think, because they can do 80% and they can do LODOC. LODOC means you have to provide, I think, the latest BAS statement and that sort of thing, and they would work out what would be your income. And obviously, you have to look at the asset and liabilities as well. So it is a very good product. Now, that really suits for self-employed people. And that is for loan less than $1 million, and they're the best in the market. And they're
That's
not
one
even.
we just did.
It's not.
That's one we just did like a dozen. There's
Yeah.
a big deal that we got through.
No, this one is 80%.
Different one?
Yeah.
Okay.
And it's 80%.
Yeah.
I mean,
Yeah, it's crazy. It's great. Wish I had that when I did a couple of mine in there.
yeah. And you did have one with the one in the one that you sold or something.
Yeah, I've got another one. I've got some more with it, but I've had like commercial loans with them. They're down like 10% LVR or like they you know the repayments I paid like extra like 10 grand a month on each loan sort of thing. Justin, just sorry, I've had 5-year interest only, another 4-year interest only. My tactic is to exhaust the interest only and convert them to principal interest by locking the principal interest lower rates because I have no other option. Rose, if we can maybe get a printout of this this chat. Justin, if you could maybe just send an email to the team and Rose's email. What's your email, Rose? What's your
Rose at Zinger Finance.
Rose, R-O-S-E at Zinger, Z-I-N-G-R, finance.com.au, just like the burger with no flames around it. So, yeah.
And Rose like a flower.
Rose like a flower. So with it, send Rose an email and just with your position, get it, I'll have a look at it. I want to have a follow-up with Rose to see what we can do, if there's something we can, we did Justin's loans prior, and we just want to see if we can, before APRA, and we want to see if we can, you know, take advantage of the, you know, his position to be able to lower the interest rates and get the best rate for him and whatnot. So that'd be cool. Steve, many advisors said go for the interest only loan, but the interest only loan is 0.5% higher than the principal interest rate loan. Correct. You need to work out at what phase in your portfolio you're at. Some banks still charge the same, like very similar, like the second tier lenders.
Second tier lender, are, you know, Raisin Mac is a very good second tier lender. It's very competitive in interest rate.
But the 0.5 higher with the principal interest, when mine a couple of years ago went to principal and interest, I was actually happy that they went there. I was like, this has come down, and the way I fixed some of them, it was cool. I went and called the banks, tried to get them to remove like 0.5% extra on top. Said, look, I'll bring a few of them to actually go principal and interest to get a cheaper rate. But it depends on where your portfolio is at. Yeah, are you in accumulation or consolidation? Jerry, hi Rose, Nathan, what would you consider a good fixed rate at the moment, say for a 3-year period? I'll leave that on you.
Oh, okay, that's for owner or
Depends.
investment, yeah.
Depends. Maybe we could do a couple of different scenarios.
Yeah.
Maybe we've got Rose on the spot here at the moment with
fixed rate?
Yeah, with fixed rate.
At the moment, we have, I think, fixed rate for investment is.
Came prepared for the question.
Okay. Discount is okay. Let's choose the cheapest one. 3.04 interest only and 2.84 fixed BNI.
But you go to Westpac, go to ANZ, and you can get the owner occupier down to 2.19. Is it 2.19 or 2.29 fixed?
Fixed with ANZ. That's an owner. Yeah. 2.19 with NEP at the moment.
2.19% fixed. 2.19.
Hi guys, if you contact us, we will shop around for you. So, you know, I might be saying 2.29, 2.19. Look, that's the current loan, but I don't know what your loan is. It for investment or owner?
At 2%, Rose. Fuck. Like
2.19.
2.19. Like it's free money. It's free money. You know, if you're paying the principal repayment, then you're basically just paying the principal repayment.
I think for interest only investment, 3.04 is not bad though for 3-year fix.
Yeah.
If you have to go that that way.
I've seen some variables, like the one that we fixed where I said our staff member had refinanced, had requested a rate cut. I think it was with NAB, and they put it down to like 3.11 or something.
For on a roll?
No, for all the investments. Yeah, they went down. He's like,
B&I?
no, I don't know.
No. I think I've negotiated a lot. I think the B&I investment 3.05, and then you can go. I think I saw one 2.72 actually.
And then depending if you've got the package on it, if you've got a package with the bank, you could get an extra 20 basis points cheaper.
We always negotiate for you, as I say, you know.
Yeah. Hi Rose, I've been advised to borrow 80% against my home to buy an investment. This means I will pay less interest. I'm not sure the implications of this, as I think most people borrow 80% against the investment property. What are your thoughts, please?
Well, first of all, it depends on the purchase price, right? LMI can be very expensive, and sure, you're using the way we structure it. You get a home loan, you at your house. We're gonna split the loans like on our own. First split, the second split is investment loan. Now, if there's enough equity there, why would you pay an LMI, right? If you can afford 20%, because you know, LMI can be like 23,000. That's a lot of money. Yeah. And then later on, I suppose you can always we can always reassess the investment loan. Maybe there's enough equity there to pay your, you know, your owner off. You know, that split that we use to as a deposit.
We've got so many questions coming through. One from Adam: can I book an appointment with Rose specifically?
Yes, Adam.
So Rose gets, you know, a lot of people wanting to talk to her.
I know.
Well, as soon as they hear that Rose is my personal broker that's helped me out over the course of the last 15 years, 16 years, on over 80% of my loans.
And yours is even difficult because just imagine how many companies do you have? How many? I have to study all those books, right?
Yeah. There's over, in the whole group, there's like, in my cupboards and that, there's over like 80 different entities. It's like,
you don't even know how it was structured. I know how it's structured.
It's, yeah. There's like, normally someone will have like, oh, here's the trust, here's the corporate trustee, and then there'd be like on a little diagram, I've got pages and pages, peer 2, peer 3, peer 4 of those structures and how they go through.
Yeah, that's how I suffer. I have to study all his company, how it links to, you know, like, and you have this lifestyle and what is the trust, what's, you know, what's the distribution of the trust. Yeah. So imagine reading all this financial and also learning the structure of the company, because every time you search Nathan name, I said, oh, he owns this, he owns that.
Yeah.
I said, oh, okay. So I had to start doing the organizational chart type of thing, you know, to
show to the bank,
the bank that this is the link, you know, this is how it is structured.
Yeah. Taking the loan to the bank needs to look like a business plan. The banks, to get them to take you serious, if you get a larger portfolio, you need to present it as a business plan. And, you know, brokers don't understand this, right? Brokers haven't built large property portfolios. My team, experts, we've got, you know, people that have been here for many, many years. Typically, like our brokers have always been, you know, nurtured and trained inside the business, so they're not your typical broker. Like, none of them have had to go outside the office really beforehand, like a normal broker, but the work that they do is very strategic and
yeah, and also not to boast it, like with Zinger, the brokers we constantly write loans. If you compare, I know what is out there. There are brokers that they don't even write loans, right? They could probably write 2 loans a month. Whereas here we write like, how many loans we do interviews?
For example, it could be like 80 loans per member. Like,
and one broker could be submitting 32 loans, one broker, just to do that in a week or something.
Exactly. Like that's 120 loans a month.
Yeah, and we've seen them all. So, you know, like, you go to some other brokers, I said, oh yeah, we can do this or something like that. Oh, they don't have the experience that our broker has, because we've seen them all. Like, can you imagine one of our brokers would write 32 a week and constantly doing appointment after appointment? I mean, I'm booked already, like, but I still keep taking it because
I always say that what a lot of the work that Zinger does is charity, right? Always make it as like when people go, tell me about your business, like over a dozen different companies. And what do they do? Oh, I've got finance, got legal, got property management, got education, got all different stuff. And like, oh, that must be cool. It's like, mate, that is a charity. Zinger is a charity. It's doing a task to help people be able to build their portfolios. Writing a loan of 100 grand or 50 grand or 20 grand to get an equity. Like,
it's very tedious, the paperwork that we require from you, and it's sometimes
brokers won't do it. Brokers won't do it out there. They're just like, oh, it's too hard. I'll take a first home buyer with a $500,000 loan. Thank you. I'll write the loan, get paid.
Some of those brokers would not take a loan less than 300,000. They would say like, go away, find another broker. And we do it, a lot of work.
Just like 15 grand, 20 grand.
Just imagine the way we do it. We read your statement. Make sure, did we find anything unusual on that statement? And then we look at your transaction account and say, hang on, there is a transfer from this account to that account. Then we ask you, there is a transfer there. Do you have that account? Do you own that account? Say, yes, we do. Then we're going to ask again the statement. It's really studying your financial, like your transaction account, your loan statement, make sure there is no default, and your expenses. For example, you told us your expenses is only 2,600, and then we look at the expenses. I said, hey, this is more than, so we cannot submit this to the loan because it makes us look stupid. Like the bank would only come back to us and say, like, reject it. So
we would get marked down at the back of the bank by saying we're not a premium broker.
We get graded by the bank as to the quality of our submission. So to say that if you're right, I have one of the thing that it says, oh, okay, we charge 1,500 for newcomers. Like the loan is only like 117,000. I mean, what do we get? 700. And that 700 doesn't really pay the hours we keep calling you, the outspend of that. So when we take our job, we take it seriously. So I think, as Nathan said, some of it are just a charity
to help people build
a portfolio. So sometimes you think, oh, you're helping us by putting the loan with us. Look, we do a lot of work. We're
helping people. They're not helping us. We don't need to. We can take the big loans, but it's like
and then the compliance that are involved. I mean, how many times I said, this is the compliance. Make sure you understand the compliance. This is the rate that we're giving you. These are the repayments that we're giving you.
Yeah.
And then we have to hold your hands. I do anyway. From the time we do the conversation to the settlement, and there are the work that we do that you don't know, we contact the solicitors, right? Make sure it does happen. So back and forth. So these are
a lot of stress.
A lot of stress.
Constantly, some of the staff have got noise deadening headphones that are in their head, and they're just constantly like they're plugged in. They're plugged into the matrix. They're like
and we're in the bank as well to follow up your loan, because obviously under pressure, right? And where is it at? And there's some exception because sometimes the client doesn't disclose everything, and we just discovered, the bank just discovered that you have these. So
we'll get back to some of the questions. We're running out of time. We'll go over a little bit for you guys. You've dedicated your night. I can see when everyone starts dropping off that you want us to let you go to bed or whatever.
Yeah.
Sal asked, is it possible to negotiate the rates for the Big Four lower than the advertised rates?
All the time.
That's what we do.
Yeah.
That's what we do. If you've got a loan with anyone, if you're thinking of getting a loan, you've got a loan, you can either go to a bank and they're going to just push you to one of their products, which probably may not be the best all the time. Sometimes they're great, but sometimes they're limited to one bank and four walls, where you could be limited or have the capacity to go to 100 different lenders. But yeah, if anyone's got a loan, thinking of getting a loan, looking at how can I tweak my position, like an extra 5 grand a year, 10 grand a year, 50 grand a year. It's all about tweaking that portfolio. A lot of people go, how can you retire from building out this portfolio? If you've got $1 million worth of debt, or $2 million worth of debt, or $3 or $4 or $5 million, the more debt, the better chance you've got of retiring in 2020. This is a market which will allow you to be able to retire. If you can drop interest rates from 4% to 2%, the difference between that is 2% on $1 million. It's 20 grand a year. You've got $3 million worth of debt, drop it by 2%, there's 60 grand a year. Like that's a wage or something. It's $5 million, you've got
100 grand a year you could save. So reach out to the team, reach out to Rose. I'll give you some details. You can either email rose@zingerfinance.com.au, email the team at info@zingerfinance.com.au, reach out to my team at admin@B.Invested, send me an email. However you want to get in contact, we'll put you in contact with the team, which do, finance some of the largest portfolios in this country. There's less than 17,000 people in this country which have 6+ properties in their portfolio, and we've been a crucial part as a B.Invested group of companies to be able to, build a large chunk of those portfolios with great pride as well. Angela asked, with the fixed rate at a low of 2.09%, is it worthwhile to take the fixed rate for 2 years? Do you foresee the rates will drop further? Personal call whether you should take a fixed rate or not. We can't influence you on that front. I believe interest rates will go down cheaper. I certainly don't see them going up higher anytime soon. With a lot of uncertainty out there, one could be, excited to fix it at that. But what about if you fix it for 2 years, for example, and in 12 months' time, a cheaper rate comes along, you could fix it at 1.5 for 5 years or whatever the case may be, and you don't have the capacity to move. So you need to factor in all aspects, and if you'd like, reach out, the team can help you. Braden, can I include my partner's income to my application but still only apply my name?
Oh, no.
Oh, yeah, I'm just breathing in it.
So for example, you're okay. The bank would always ask, like, if one is a co-borrower, there's always a question there, what's the benefit that this co-borrower will get, right? So that's one of the flags. So if your partner is not if you are husband and wife, he or she could be your co-borrower because the benefit of being a husband and wife. But if you're not married or just, de facto, it's hard to prove that, you have to prove you're de facto, I don't know, but normally with married couple, it's okay that only one person in the title and the other partner.
Two on the loan, yeah.
Mm-hmm.
This one looks like a long question here, so from Joel. So I'll get to your question here. G'day, Birch and Rose. Thanks for all the great info. Thanks a lot for tuning in this evening. I currently have 400 grand equity in my principal place. I'd like to take out a second mortgage on this home and use that to buy an investment property, thereby making the interest payments on the loan tax deductible. However, I'd like to upgrade my principal place in a few years. My question is, when I sell my principal place of residence and buy a new home, can I security swap the second mortgage from my current PPR to my new home and maintain the tax deductible nature of this portion of my mortgage on the new home? I guess you could security swap it.
Yes.
But if you can draw a clear line of where that money has come from, and a portion of that loan has been used to fund an investment property, so on and so forth, speaking to your accountant, I put you in contact with Ridwan. It is busy. It is tax time. I was on the phone to him literally 2 minutes before we started with record here with everyone. Make sure you've got the right team around you. You're only as strong as the team that you've got in order to make that happen. But technically, I would believe it would be possible, Rose.
Yes.
Yeah. Cool.
Very possible.
If you've got access to $400,000 in this market, a lot of people don't realise the capacity that they have, right? Like someone could have bought a red brick house in Western Sydney for $500,000 10 years ago, and it's worth $1 million or 1.2 now. You might owe 400. If you had a 400 grand worth of equity in a line of credit you could use, and your servicing wasn't an issue, a deposit of $50,000, that's 8 deposits there to purchase 8 new assets, right? And it's the game of owning assets in this market. If we were to see the market double tomorrow, would you want to see double, $1 million into $2 million, $5 million into $10 million? I'd want to take the largest asset base through a market cycle. And, having access to 400 grand in equity is a very, very good position. Make sure that you use it wisely. Make sure you protect your servicing and keeping yourself finance ready at all sort of times. P.S. I'm well aware that this is just general advice and not personal. Of course, anything that was said this evening isn't financial advice. We're just here having a chat about finance and stuff and answering some of your questions you may have. So the question is, do I need to have all my loans with one bank, or can I negotiate better rates like my 2 investment loans and my own occupier with the same bank?
You don't have to be in one bank. You can have different banks, but then again, you have to remember that the discount the bank give you will be based on the volume of the loan. So if you want to get the better discount, maybe put most, streamline them in one lender.
Yeah.
If possible. Sometimes you couldn't do that because when you move it from one lender to another, there wasn't enough equity, or servicing could be an issue.
Can you cash out using equity from an unsecured property? Yeah, like you could pull out equity from one property and use that to buy another property unencumbered?
Yes, of course. So if we've done one before, and just recent actually. So the property is unencumbered. We put a loan on it, and the bank was asking what's the purpose, because it's a big cash out, but we just say that person just needs to be reimbursed with the money that she puts in towards the purchase.
Yeah. I have refinanced my principal place, taking out a separate loan on it to cover the deposit for my investment property. Once my investment property grows in value, can I refinance to pay the refinance amount of my principal place of residence? I hope that makes sense.
But we've been repeating that all the time. That's for example, if the investment property would have equity, we could increase that loan and pay off some of the split that you've done with your owner.
Then you take it out, but you would be able to claim that. Let's say you buy a 250 grand property, use a 50 grand equity, 200 grand new loan. You can still claim that 50 grand component from the principal place of residence. If you wanted to go pull out the equity and put it back in there, you're just taking it from one pocket to the other. It might make you feel better, but it's more of just a data entry, off balance sheet transaction. But I'd rather take the capital and then go and purchase more investment properties myself, so I can grow out that asset base and have a larger exposure in the market. Cameron, if I have a multiple property portfolio accumulated 10 years ago, and now all the properties have increased in value, so LVR has reduced from 80% to 60%. Would it be possible to refinance to access the equity if you do not have income, for example, parental leave? With that, I'll leave that one with you. If you don't have any income,
it's hard.
It just depends. Like, it's important to work out what your position. I think that this investor is working with someone. Maybe it's probably more of a question like on a specific sort of scenario to take them to the broker, because how it's structured. Like if someone's been on parental leave for maybe like 6 months, I'd imagine, and they go back to work in 2 months. How would the bank view that?
Okay, we do. For example, there is this one is on maternity leave. So obviously only one partner is currently earning. So while she's on maternity leave, but has the intention to go back to work, we get a letter from the employer as to the date of her going back and what will be the income post maternity. That has to be confirmed with the employer. Now, what the bank was basing is that, say, for example, because we're granting you this loan, you must have, in lieu of her income, we must have enough savings to cover her share of that repayments. So say, for example, the repayment is 2,000 and she'll be back to work in the next 6 months. And so that means her share is 50%. That means her share of that repayment is 1,000. So we have to provide the bank at least $6,000 as a, towards her contribution, more towards the mortgage repayment. So we can basically do it, but the bank needs to make sure that you have enough cash to cover the time while you're on maternity leave.
So from investment goals like buying properties for investment for the long run to hold, you suggest focus on interest only, and after the 5-10 years refinance to another lender with interest only, no need to pay for the principal. That's not what Rose was saying it is an option to do that. If you, instead of having a stale loan, you could sometimes get better terms, whether it be if you wanted to extend for another 5 years, or having that loan, which is a 30-year loan, 5 years principal, interest only, and then 25 years principal and interest. If you wanted to have a whole 30-year loan left, you could refinance it out and recycle that loan and potentially even get better rates and better structure on it. So it's important to shop around, because what you settle on as a loan today doesn't mean that in 5 years' time or 10 years' time will be the best loan facility for you. I realise the cleaners have come in as well.
so we're going to leave shortly.
Everyone is leaving already.
Everyone's leaving. I'm just going to go through a few questions that pop up. We've got a lot of, maybe what we can do is print off a copy of this, and we can make some videos, like little snippets for Zinger. The team can come on and answer these questions and upload them to YouTube.
Maybe we could also, one of the brokers can also call them and answer those questions.
Anyone that wants to have a chat with Zinger, reach out. What's the number for Zinger? Do we know the number? We don't know. Call the main line here, 1300 367 925. Just hit us up on the B.Invested line. Flick us an email at info@zingerfinance.com.au. Actually, I just noticed the slides have been up. I know there's no other slides, it's just to that. But yeah, flick us an email, give us a call, reach out, flick me an email, flick Rose an email, just rose@zingerfinance.com.au. We'll have a look at your position. There's lots of questions here. I think we've got so many questions. It's really awesome. So
it's good though, because that means like you guys are really into it.
Yeah. So with it, let's aim to answer some of these questions on videos, make some little short snippets, and get back to you guys over the course of the next few weeks. If you do have the questions, reach out to the team. This is a once in a generation sort of sleight of hands and wealth transfer that's going on at the moment, and being able to finance it, fund it, and be able to capitalize on this market is a really, really cool time. So make sure that your loans are structured correctly, make sure that your everything's awesome to be able to take advantage of this time. Yeah, on that note, thanks a lot for
Thank you and good night.
We'll catch up soon, and Rose looks forward to helping you achieve your goals and finance your dreams and goals. So talk soon, guys. Bye for now. Have a great evening.
Thank you.